Hello everyone, I'm Vikramaditya here. Welcome to SOFTECH, and in this session I'm going to share with you all a couple of question and answers which are related to finance. And these question and answers are in general for everyone who is in finance sector, like whether you are Bcom finance guy, MBA finance guy, or you are chartered accountant or ICWA, or even if you are on a senior most of finance level, or even if you're applying for a CFO job, the basic finance question and answers which you must know are the things that I'm discussing with you all in this session. So this is important for everyone who's related to finance, and if you know anyone who's related to finance and is looking for jobs or changing the jobs, or you want to improve their skill set, then I suggest you to strongly share this session to all of them. It might help them a lot. Why do capital expenditures increase assets while other cash outflows like paying salary, taxes, etc. do not create an asset and instead instantly create an expense on the income statement that reduces equity via retained earnings? Capital expenditures are created because of the timing of their estimated benefits. The lemonade stand will benefit the firm for many years. The employee's work, on the other hand, benefits the period in which the wages are generated only and should be expensed then. This is what differentiates an asset from an expense. Walk me through a cash flow statement. You can start with net income, go line by line through major adjustments, depreciation, changes in working capital, and deferred taxes to arrive to the cash flows from operating activities. Mentioned capital expenditures, asset sales, purchase of intangible assets, and purchase sale of investment securities to arrive at cash flow from investing activities. Mention repurchase, issuance of debt and equity, and paying out dividends to arrive at cash flow from financing activities. Adding cash flows from operations, cash flows from investments, and cash flows from financing gets you to the total change of cash. Beginning of period cash balance plus change in cash allows you to arrive at end of period cash balance. What is working capital? Working capital is defined as current asset minus current liabilities. It tells a financial statement user how much cash is tied up in the business through items such as receivables and inventories, and also how much cash is going to be needed to pay off short-term obligations in the next 12 months. Is it possible for a company to show positive cash flows but be in grave trouble? Absolutely. Two examples involve unsustainable improvements in working capital. A company is selling off inventory and delaying payables, and another example involves lack of revenues going forward in the pipeline. How is it possible for a company to show positive net income but go bankrupt? Two examples including deterioration of working capital, increasing account receivable, lowering accounts payable, and financial shenanigans. Now, I buy a piece of equipment. Walk me through the impact on the three financial statements. So initially there is no impact. Income statement, cash goes down while the profit goes up, and balance sheet and the purchase of PP&E is a cash outflow, cash flow statement. So the property, plant and equipment is a cash outflow, the cash flow statement. So over the life of the asset, depreciation reduces net income statement, and the property, plant and equipment goes down by depreciation while retained earnings go down balance sheet, and depreciation is added back because it is a non-cash expense that reduced in the net income. In the cash from operations section, cash flow statement. Why are increases in accounts receivable and cash reduction on the cash flow statement? Since our cash flows statement starts with net income, an increase in accounts receivable is an adjustment to net income to reflect the fact that the company never actually received those funds. How is the income statement linked to the balance sheet? Net income flows into retained earnings. What is goodwill? Goodwill is an asset that captures excess of the purchase price over fair market value of an acquired business. Let's walk through the following example, like acquirer buys Target for 500 million in cash. Target has one asset, the product plant equipment with book value of $100, debt of $50 million and equity of $50 million. That would be equal to book value and of $50 million. The acquirer records cash decline of $500 to finance acquisition. Acquirer's property, plant and equipment increases by $100 million. The acquirer's debt increases by $50 million and acquirer records goodwill of $450 million. What is a deferred tax liability and why might one be created? Deferred tax liability is a tax expense amount reported on a company's income statement that is not actually paid to the IRS in that time period, but is expected to be paid in the future. It arises because when a company actually pays less in taxes to the IRS than they show as an expense on their income statement in a reporting period. Differences in depreciation expense between book reporting and IRS reporting can lead to differences in the income between the two, which ultimately leads to differences in tax expense reported in the financial statements and taxes payable to the IRS. What is a deferred tax asset and why might one be created? Deferred tax asset arises when a company actually pays more in taxes to the IRS than they show as an expense on their income statement in a reporting period. Differences in revenue recognition, expense recognition, such as warranty expense and net operating losses NOLs can create deferred tax assets. I hope you enjoyed this article, and I'm going to further continue with a few more interview questions related to finance. So what are the various streams of accounting? Streams of accounting: financial accounting, cost accounting, management accounting. Management accounting is the process of analysis, interpretation and presentation of accounting. Financial accounting and its characteristic features. Process in which business transactions are recorded systematically in the various characteristics featured in the financial accounting. Financial accounting is something which we need to explain about the cost accounting. So let me put this question in this way. What is cost accounting and what are the objectives of doing it? So cost accounting is the process of classifying and recording of expenditure incurred during the operations of the organization in a systematic way. Define management accounting. What are its objectives? Management accounting is the process of analysis, interpretation and presentation of accounting information collected with the help of financial accounting. What is the scope of management accounting? Scope of management accounting would be financial accounting, cost accounting, revaluation accounting, control accounting and marginal costings. Compare financial accounting and the cost accounting. Financial accounting protects the interests of outsiders dealing with the organization, that is shareholders, creditors, etc. Financial accounting versus management accounting. Financial accounting reports are used by outside parties such as creditors, shareholders, tax authorities, etc. Whereas management accounting reports are used by managers. Compare cost accounting and management accounting. The scope of management accounting is broader than that of the cost accounting. In cost accounting, the main emphasis is on cost ascertainment and cost control. What is journalizing? What are the columns of a journal? Journalizing is the process of recording business transactions in the journal in the chronological order. What are subsidiary books? Why are they maintained? Subsidiary book is the subdivision of journal. These are known as books of prime entry or books of original entry. List the type of transactions entered in the journal proper. The journal proper is used to record following transactions: opening entries, closing entries, transfer entries, adjustment entries. Define cash book. Single column cash book, double 2-column cash books, 3-column cash books. Define purchase day book and its importance. Purchase day book, the purchase register, is the book of original entry in which all the transactions relating to the only credit purchase. Explain sales day books and its importance. Sales day book, the sales register, is the book of original entry in which all the transactions relating to only credit sales. Explain purchase return register. Purchase return register is a register or a book in which the transactions relating to goods returned to the suppliers are recorded. Explain sales returns register. Sales returns register is the register or a book in which transactions relating to goods returned to the businessman. Explain journal proper. The journal proper is used to record following transactions. Journal proper is the book of original entry in which those miscellaneous transactions have been recorded. What is a ledger? What do you mean by ledger posting? Ledger is the book where the transactions of similar nature pertaining to a person, asset, liability, income or expenditure have been recorded. What are the control ledgers? What are the purposes of maintaining it? Purposes of maintaining control ledgers are: control ledgers records the individual accounts. What do you mean by balancing ledger account? Balancing of ledger account means the balances of debit and credit side should be equal, and this involves following steps. So the steps I've covered actually in a detailed way in another session. So I'll come back to that. Explain bank reconciliation statement. Why is it prepared? So bank reconciliation statement is a statement prepared to reconcile the balances of cash book maintained. What are the reasons which cause passbook of the bank and your bank book not tally? Bank charges, amount collected by bank on standing instructions of the concern, direct payment by customers into the bank account, etc. would actually cause differences in the tally book. What are the important things to be remembered while preparing a bank reconciliation statement? While preparing a bank reconciliation statement, following important points needs to be remembered. So basically, bank reconciliation statement is prepared either by starting with the bank passbook balance or cash book balance. If the balance of the cash book is taken as a starting point, then cash book balance is to be adjusted in accordance with the entries passed in the bank passbook and vice versa. For example, if the balance is taken as per the cash book, then the following items will be added: checks issued but not presented for payment, amount credited in the passbook but not in the cash book, deposits made in the bank directly, wrong credits given by bank, interest credited in the passbook. Why are profit and loss accounts prepared? Profit and loss account is a period statement which is prepared to show the profit or loss incurred by the organization. What are the components of profit and loss account? Explain them. Expenses and losses are shown on the debit side of the profit and loss account. Revenue, sales and turnover, cost of goods sold, that's popularly called as COGS, gross profit, revenue minus the COGS, expenses, net profit, the gross profit minus the expenses. So the formula would be sales minus the cost of goods sold is equal to gross profit minus expenses is equal to net profit. What are the groups under which errors in accounting are placed? Errors in accounting are placed in the following main groups: errors of omission, errors of commission, errors of principal, errors in original entry, complete reversal of entries, errors affecting the trial balance, and compensating errors. What are the type of errors which have an effect on trial balance? Okay, following are the types of errors which affect the agreement of trial balance. Error of omission, wherein the full transaction is omitted from the books of accounts. Error of commission, where we have entered the correct amounts but in wrong person's account. Error of principal, this type of error takes place when an item is entered in the wrong head or class of accounts. Error of compensation are that errors which cancel the effects of each other. Error of complete reversal of entries, these errors occur when we debit and credit the two or more aspects of a transaction wrongly using correct figures or amounts. Error of original entry, entering wrong original figure or amount in an account. Error of transition, error of transition can be defined as switching the sequence of digits of amount or figure of a transaction. What steps would you take to locate the errors in case of trial balance disagree? If the trial balances disagrees. So in case trial balances disagrees, following steps should be taken to locate the errors. So totaling of all the subsidiary books and trial balance should be checked carefully. Opening balances of all accounts are properly brought down in the current year's books of account. Ledger accounts have been properly balanced and the balances of ledger accounts have been correctly shown in the trial balance. To locate some errors in the difference in the trial balance is halved. Another way is dividing the difference in the trial balance by 9. If the difference gets divisible through leaving any remainder that indicates the transposition of the amounts, that's transposition actually. So to locate certain other errors, current year trial balance can be compared with the trial balance of the previous year. What measures would you take to rectify the errors? The other ways of rectifying the errors is by passing rectification entries. These entries are passed when the errors which will be affected. What are the various elements of costs? Material cost. This is the cost of material or the commodity used by the organization for its production purpose. Labor cost. This is the cost incurred in the form of remuneration paid. What are the overheads? How are they classified? Overheads are the aggregate of indirect material cost, indirect labor and indirect expenses. Define factory overheads, office and admin overheads, selling and distribution overheads. Factory overheads are the overheads which are incurred from the stage office and administration from the stage, and office and admin overheads are the overheads incurred for the overall administrative work. So office and admin overheads are the overheads incurred for the overall administrative work. Selling and distribution overheads are the overheads incurred from the stage of final manufacturing. Define gross profit. Gross profit is a company's revenue minus its cost of goods sold. It is also known as gross margin. Define net profit. Net profit or the operating profit, net profit, also known as operating profit, is actual earnings of the company. What are the steps in procurement of material? Following are the steps for the procurement of material. Following particular appears in the purchase requisition. So the steps are like need recognition. The business must know it needs a new product, whether from internal or external sources. The product may be one that needs to be reordered, or it may be a new item of the company. And the specific need, the right product is critical for the company. Some industries have standards to help determine specifications. Part numbers help identify these for some businesses. Other industries have no point of reference. So the company may have ordered the product in the past. If not, then the business must specify the necessary product by using identifiers such as color or weight. Source options. The business needs to determine where to obtain the product. The company might have an approved vendor list. If not, the business will need to search for a supplier using purchase orders or research a variety of other sources such as magazines, the internet, or sales representatives. The company will qualify the suppliers to determine the best product for the business. Prices and terms. So the business will investigate all relevant information to determine the best price and terms for the product. This will depend on if the company needs commodities, readily available products, or specialized materials. Usually the business will look into 3 suppliers before it makes a final decision. Purchase order. The purchase order is used to buy materials between a buyer and a seller. It specifically defines the price, specifications and terms and conditions of the product or service and any additional obligations. Delivery. The purchase order must be delivered, usually by fax, mail, personally, email, or other electronic means. Sometimes the specific delivery method is specified in the purchasing documents. The recipient then acknowledges the receipt of the purchase order. Both parties keep a copy on the file. Expediting. Expeditions of the purchase order addresses the timelines of service or material delivered, and it becomes especially important if there are any delays. The issue most often noted including payment dates, delivery times, and work completion. Receipt and inspection of purchases. Once the sending company delivers the product, the recipient accepts or rejects the items. Acceptance of the items obligates the company to pay for them. Invoice approval and payment. 3 documents must match when an invoice request payments have been done: the invoice itself, the receiving document, and the original purchasing order. The agreement of these documents provides confirmation from both the receiver and supplier. Any discrepancies must be resolved before the recipient pays the bill. Usually payment is made in the form of cash, check, bank transfers, credit letters, or other types of electronic transfers. Step 10. Record maintenance. In the case of audits, the company must maintain proper records. These include purchase records to verify any tax information, and purchase orders to confirm warranty information, purchase records in reference future purchases as well. How do you calculate the following inventory levels? Reorder level, maximum level, minimum level, and the danger level. What is ABC analysis? Explain what are the advantages of it. ABC analysis means always better control. Is a technique which classifies the various items of inventory. So the advantages of ABC are like end of life management. Every product goes through 4 phases during its lifespan: launch, growth, maturity, and decline. So once the product reaches the maturity stage, it is bound to decline sooner or later. Customer demand plays a vital role in end of the life management. With the concept of ABC analysis, inventory planners can forecast the demand for products forehand and manage the stock levels accordingly. The maturity and decline period is different for the different products. With decrease in demand, the sales will fall, and therefore it would be wise to reduce the inventory levels to minimize the carrying costs on the items and also avoid having obsolete stock. Supplier negotiation. It is obvious that the company would make most money by negotiating with suppliers of the class A category, since 70 to 80% of the money is spent on them. An offer may look lucrative from afar, but never accept the very first one. Make a counter offer in return. Wait for the supplier to revise his numbers. If the supplier is not willing to budge, you can still make the most of the deal by negotiating other features like providing post-purchase services, reducing the down payment, free shipping, etc. The negotiation needs to be a win-win approach. The supplier needs to make reasonable profit from the deal while helping your company get desired quality product and service. Now, the inventory optimization. Optimizing inventory is a popular benefit of ABC analysis, as it allows inventory planners to organize high priority items aligning to customer requirement. Depending on the demand fluctuations, the inventory is stocked to cater to high demand items and also carrying low stock for undesirable items. And strategic pricing, we have ABC analysis of inventory helps in setting the prices very strategically for products which bring more value to the company. The company will have to monitor those products which are highly desirable to customers and have an escalating demand. Based on that data, the company can increase the prices of these items by a few extra dollars, which will make a huge impact on the profit. Another strategic pricing option to consider is to consolidate suppliers or consider transferring business to a single supplier. Purchasing more goods from a single supplier will reduce carrying costs and complexity costs associated with them. And resource allocation. Resource allocation with ABC analysis is a continuous process requiring periodic tracking of Class A items. Since these items are of utmost value, the stock level must always align with the customer demand. In case a Class A item is no longer desired by the customer or has fairly low demand, the item needs to be moved to a lower classification of B or C. Customer service levels. So not all products can be treated the same or achieve same customer service levels. The service levels for different products depends on the multiple factors like the item cost, quantity sold, and the margin on the product. There is no point crowding your warehouse with low margin products which are sold once in a while. The ABC analysis allows planners to set service levels based on the product classification, which improves the overall supply chain performance, carrying less safety stock. There you have it, the 6 target benefits to adopting ABC analysis of inventory method in your company. If you have employed these techniques in your business, please share the advantages and benefits you enjoyed. And you can write it in the comments actually. Explain bill of materials. Bill of materials is the list of all materials, including all the details and quantity as required for a job or a production process. Explain the perpetual inventory system. Perpetual inventory system is a system under which continuous stocking takes place. Why should overstocking be avoided? Overstocking should be avoided due to the following consequences of overstocking should be avoided. So just name a few of the disadvantages of overstocking. First and foremost is the storage capacity fees. Storage capacity and the related storage fees are a concern for the companies holding more inventory than is needed. It takes space and resources to hold inventory. Companies lose profit by paying labor for maintaining the storage space, organizing the stock and transporting the stock from one place to another. Companies that rent storage space lose additional profit by paying rental fees, to store unused stock. Absolute stock. Companies that keep up with the buying trends might find overstocking inventory to be disadvantage. Consumer tastes change quickly and products can become outdated if they sit around in an inventory for a few months, particularly when it comes to clothing and other fashion items, something like that. So in these cases, a warehouse full of trendy product quickly becomes a warehouse full of devalued products. Perishable products. Overstocking perishable items often results in the items sitting in storage past the recommended use by date or the expiry date. For example, food business cannot sell out-of-date products because of the risk to the health and the safety of the customers. In these cases, overstocking results in items that must be thrown out, meaning they are total loss. Discounts. A business owner who overstocks often finds himself in the position of needing to sell the inventory at a deeply discounted prices in order to clear up space for new inventory. By selling discounted stock, the business suffers low margins and profits and sometimes even faces huge losses. Cost. A major disadvantage to holding too much inventory on hand is the negative cost implication. Purchasing any type of inventory or product ties up with the funds of the company and prohibits those funds from being used elsewhere in the business. Holding too much inventory ultimately affects the cash flow of the business, especially when the inventory is sitting in the storage and is not being sold for profit. What can be the consequences of understocking? Production process cannot be operated efficiently, resulting delivery schedules. Define types of tenders: single tender, limited tenders, open tenders, and global tenders. So single tender, when only one source of product is available, then single tender is addressed to the selected supplier. So single tender, when only one resource of supply is available, then single tender is addressed to the selected suppliers. Limited tender is this type of tender is addressed to the limited number of suppliers who are reliable source of supply. Open tender is open to all the suppliers within the country who can supply the required quantity and quality of materials. Such invitation is made by advertising in newspapers, journals, etc. Open tender is open to all the suppliers within the country who can supply the required quantity and quality of materials. Such invitation is made by advertising in the newspapers, journals, etc. And global tenders is open to anybody from any part of the world to supply the required quantity and quality of the materials. What can be the discrepancies in material receipt? There are two types of categories of material discrepancies. First category includes the first category and second category. I'm going to discuss about these two. The first category includes quantity received in excess, quantity received in short, quantity damaged, recipient of incorrect quantity of material. So these discrepancies are normally caused by the transportation system. Second category would be includes discrepancies in quantity of material supplied. These discrepancies are caused by the manufacturer. So differentiate between bin card and a store slender. Bin card is a quantitative record of the individual items of its recipient, issues and closing balance, whereas store ledger records both the quantity and cost of receipts, issues and balances of item of materials received. What can be the reasons for bin card and store ledger not getting reconciled? The following are the reasons for the bin card and store ledger not getting reconciled. It can be an arithmetic error in calculating balances of the sheets. If posting of the transactions has been made on a wrong bin card or store's ledger sheet. If issues transactions are treated as receipt transactions or vice versa, then this may create the difference in both the balances. Non-posting of certain amount in any of the sheets. Explain valuation of receipts. Valuation of receipts is the price billed in the invoices by the supplier. Following points should be kept in mind for this purpose. There are few things that we have it in the valuation receipts. The trade discount is deducted from the basic price, and all other amounts as billed by the supplier are added, like excise duty, sales tax, octroi duty, etc. Joint costs may be distributed on the basis of the basic price of the material. In case of imported material, the cost of the material consists of a basic price, customs duty, clearing charges, and transport charges. Explain the valuation of issues and valuation of returns. Valuation of issues is a complex process because the material may be issued out of the various lots which might have been purchased at various prices. Following methods are used for this process: first in, first out, the FIFO; last in, first out, the LIFO; average price method, simple average method, weighted average method, highest in, first out, market price, specific price, and a standard price. Valuation of returns indicates the material returned by the production department to stores department. This valuation is done on two bases: at the same price at which the goods have been issued, and at the current price of issues. Define average price method and weighted average method. Average price method is a method by which the value of total assets or expenses can be calculated. Weighted average method is the method of calculation in which the weighted average of both the lot sizes have been calculated. What are the techniques of inventory control? Economic order quantity, fixation of inventory levels, and maximum level. Define economic order quantity. Economic order quantity is the quantity which is fixed in such a way that the variable costs for managing the inventory can be minimized. Define fixation of inventory levels and maximum level. Fixation of inventory levels facilitates easy maintenance and control of various materials in a proper way. However, the following points should be remembered. Only fixation of inventory levels does not facilitate inventory control. A constant watch on the actual stock level of materials should be kept so that proper action can be taken in time. The levels which are fixed are not permanent basis and are subject to regular revision. In maximum level, this is the top level which indicates that level of material stock should not exceed this level. If it does, it may involve blocking of funds in inventory, which may be used for some other useful purposes. This level is fixed after considering the following factors: the maximum usage, lead time, storage facilities available, prices of material, other various costs involved in insurance cost, storage cost, etc., availability of funds for procurement of material, and nature of material. What is a marginal costing? What are its features? Marginal costing is the ascertainment of the marginal cost, which varies directly with the volume of production by differentiating between fixed. How is the concept of marginal costing practically applied? So, evaluation of performance, profit planning, fixation of selling price, make or buy decisions, optimizing product mix, cost control, and flexible budget preparation. What are the limitations of marginal costings? The limitation of marginal costing is that classification of total costs into fixed and variable cost is difficult. What is the cost volume profit relationship? Cost volume profit relationship is an analysis which studies the relationship between the following factors, and it impacts on the amount of profits actually. So in the cost volume profit relationship is an analysis which studies the relationship between the following factors and its impact on the amount of profits: selling price per unit and total sales amount, Total cost, which may be in any form like fixed cost or variable cost. Volume of sales, in simple words, the cost volume profit is a management accounting tool that expresses relationship among total sales, total cost and profit. Cost volume profit relationship is one of the important techniques of cost and management accounting. It is a powerful tool which furnishes the complete picture of the profit structure and helps in planning of profits. It can also answer what if type of questions by telling the volume required to produce. This concept is relevant to in all decision making areas, particularly in the short run. Explain the profit volume ratio and contribution. The profit volume ratio is the ratio of contribution to sales which indicates the contribution earned with respect to 1 rupee of sales. Explain break-even point. How does break-even point help in making business decisions? The break-even point is a volume of sales where there is neither loss or not profit. That means contribution is enough to cover the fixed costs. Explain the margin of safety. Margin of safety is the amount of sales which generates profit. In other words, sales beyond break-even point are known as margin of safety. What is uniform costing? What is the scope of uniform costing? Uniform costing is the application of the same accounting and costing principles, methods or procedures uniformly by various undertakings. Why is uniform costing implemented? Uniform costing method is implemented due to the following advantages. It's a useful tool for management controls as the individual performance is measured against norms set for the industry as a whole. It avoids cutthroat competitions. Weaker units can take the advantages of efficient methods of production so as to increase their own efficiency. The achievements in research and development programs may be shared by the bigger units within the smaller units. It also provides the best cost control system or cost presentation in the entire industry. It assists in educating the less informed units regarding the cost accounting methods. It enables a comparative assessment between the two sectors. It helps the government in regulating prices of essential and important items. It helps in price fixation. It simplifies the work of wage boards to fix minimum and fair wages for an industry. It helps trade association in negotiating the government in the trade matters. Okay, so I hope you had a great time learning new question and answers related to finance. And if you like our video, do subscribe to our channel youtube.com/JSoftTech. Do suggest your friends also to subscribe to our channel and get benefit out of it. And you can contact us at training@jsoftech.com in case you're looking out for any kind of trainings. And if you're looking out for jobs, you can contact us at jobs@jsoftech.com. It should be JOBS here. Please type it as jobs@jsoftech.com. Thank you. Have a great day, and do write in comments what you would like to see in the next sessions, and I would definitely like to make such videos which you would be wanted to see. Thanks once again.